Today, why central banks cannot let home prices slide. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Central banks have created a monster thanks to ultra-low interest rates, easy lending rules, and of course it's all backed by government stimulus. That monster is high house prices, the growth of which have accelerated through the pandemic, with New Zealand, Australia and the UK at the top of the charts. As a result, banks have lent big, with larger mortgages and a greater share of lending going to the housing sector. In fact, APRA recognised the risks in this mortgage lending scenario by lifting the so-called buffer rate back in October, reducing the amount that borrowers can obtain by around 6%. It's obvious to anyone who looks that risks are rising, as now interest rates are turning higher, and the Bank of New Zealand has already lifted strongly and the Bank of England lifted this past week. But that creates a problem, in that if house prices start to ease, the so-called wealth effect is reversed and people will spend less. While if prices slide, banks' balance sheets get hollowed out and more capital, which is costly, is needed to the point they may ease back on new lending. And of course, lending is required for GDP growth. And also, for first-time buyers who've recently grabbed larger mortgages, negative equity haunts if that becomes an outcome of lower prices. So we think central banks will do their utmost to try to keep prices up and growing despite the debt overhang and the risks that this implies. The UK is a good example. UK house prices probably will struggle to rise in 2022 after 2 strong years of increases, according to one of the nation's largest mortgage lenders. Halifax said it expects 1% growth in the cost of an average property over the next year, after an 8% gain this year and 6% in 2020. A tax break on property purchases, along with pandemic lockdowns that prompted consumers to seek more spacious houses with room to work from home, fed increases this year. But next year, rising inflation and taxes will eat into household spending, while the Bank of England, which hiked interest rates for the first time since the pandemic began on Thursday, is expected to continue increasing the cost of borrowing. The prospect that interest rates may rise further in 2022 to subdue rising inflation, and with government support measures phased out, greater pressure on household budgets suggests house price growth will slow considerably. Russell Galley, Managing Director of Halifax, said in a statement on Friday. Halifax's prediction is more pessimistic than other forecasters, with Rightmove saying earlier this month it sees a 5% rise in 2022. Still, the lender said there's a large degree of uncertainty around its outlook, especially about how much savings consumers built up during the pandemic. And it's also not sure how durable the trend is toward living further away from the heart of cities, such as London. And so now, no surprise to see that the Bank of England wants to scrap a rule that mortgage borrowers must be able to afford an interest rate increase of 3 percentage points, a move that lenders said could help homebuyers. In essence, this buffer is parallel to the APRA buffer rule here in Australia, but of course they're wanting to reverse that. The British Central Bank said its requirement for most mortgages to be no more than 4.5 times a borrower's income, plus separate affordability rules from the Financial Conduct Authority, were sufficient. The Bank of England will consult in the first half of next year on the change, which it said did not represent a loosening of standards and would preserve financial stability in a simpler, more predictable and more proportionate way. Scrapping the requirement would help around 1% of renters in Britain, about 50,000 people, who are not able to meet the affordability test. A further 6% of mortgage borrowers, around 35,000 people, would also be able to secure a bigger loan if the rule had not been in place. The current rule came into force in 2014 during a shake-up of lending regulation after the global financial crisis. Andrew Bailey, the bank's governor, said scrapping the affordability requirement should not be regarded as a relaxation of lending standards, as the rule limiting some new mortgages to 4.5 times a borrower's income was the main constraint on riskier lending. We don't regard it as a relaxation of the rules, rather as an efficiency point, because having now got a body of evidence running back 7 years or so, we were able to take a much more substantial judgment on the effectiveness of the tests, he said. Since then, interest rates have stayed close to record lows. Although financial markets expect the Bank of England to start raising rates further, they do not see borrowing costs getting anywhere close to levels that were seen before the financial crisis. The Bank of England said a lower long-term outlook for interest rates did not automatically mean smaller risks for borrowers, as it partly reflected weaker prospects for incomes and meant there was less scope for borrowing costs to fall in a downturn. But it said its loan-to-income rule was in practice more stringent than the interest rate affordability check. Paul Broadhead, head of mortgage and housing policy at the Building Society Association, said the change would help some first-time buyers and those in pricier parts of South East England. They can clearly afford a mortgage but are hindered by the requirement to test that they could still pay their mortgage if rates were in the region of 6% plus, he said. The Bank of England also said it would increase the counter-cyclical capital buffer the bank must hold to smooth lending over the course of the economic cycle to 1% of risk-weighted assets from zero currently, effectively from the end of next year. If the economy grows as the Bank of England expects, then in the second quarter of 2022 expects to raise the counter-cyclical buffer to 2% from Q3 2023. In fact, the Bank of England cut the counter-cyclical buffer to zero at the start of the COVID-19 pandemic to boost lending. The increase to 1% implies British banks must hold an extra £11 billion of capital, and lenders already hold more capital than the regulatory minimum, so they won't need to raise more, even if the buffer went to 2%. Britain's top 8 banks, including HSBC, Barclays, Lloyds and NatWest, with Virgin Money included for the first time, all passed the Bank of England's stress tests, and the Bank of England Deputy Governor Sam Wood said it was business as usual for bank dividends, meaning no return to last year's temporary suspension due to the pandemic. The central bank acknowledged risks to the British economy's recovery posed by the Omicron variant of the virus. There are some near-term pressures on supply and inflation, and there could be a greater impact from COVID on activity, especially given uncertainties about whether new variants of the virus reduce vaccine efficacy, the Bank of England said. But Governor Andrew Bailey told a news conference he did not think Omicron's emergence risked fresh market turmoil like had been seen at the start of the pandemic. I don't think that we are in a situation where there is stress around the corner in terms of markets, he said. But the takeout here is this, that clearly the Bank of England is trying to encourage more riskier lending. And while they do claim that the 4.5 times loan-to-income ratio is an important check, they did acknowledge that more people will be able to get bigger loans. And I'd remind you that here in Australia, many lenders are still lending at 6, 7 and 8 times income. So we are already more extended than in the UK. But my takeout from today is that central banks will do whatever they can to try to stop home prices sliding. As I explained, the economic impacts of sliding house prices means that people spend less, there's a risk of negative equity, but more importantly, it puts huge pressure on banks' balance sheets. And that, of course, is really where it all stops. It's about financial stability. It's about making sure that banks don't have significant demands on their capital over and above what they currently have. So I expect to see more of this ahead to try and prop up the housing market. As to whether it will be successful, we'll wait and see. Certainly my scenarios do suggest there could be some further upside here in Australia, but also there are some downside scenarios too. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.